This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The next topic we have to deal with in the overall subject of business and gearing risk is known as adjusted present value. And this is used when, for example, funding includes a subsidized loan, or when the debt capacity is increased, or where we are funding the project by something other than just equity, really. And the steps are set out here that you have to, first of all, evaluate the project as though it's all equity finance, so there are no kind of what are called finance side effects, and then you adjust for the effect of the finance used. And the key to all of this is that the finance costs are discounted at the pre-tax cost of finance. And I kind of explain as we're going along why we need this adjustment here. So if we look at this example here, we have an investment potential here of 100 million. In times 1 to 5 we earn 60 million per annum before tax. Tax is 30%, so of course we're only going to be left with 70% of that 60 million, only going to be left with 42 million per annum. The cost of equity on geared is 20, so if we're financing this project pure equity, then we will be thinking of 20%. This project is the same business risk as before, we're just isolating the effect of gearing here. And the pre-tax cost of debt is 5%. So the starting position is what would happen if this was purely equity financed. So we're throwing 100 million at this. We're getting 60 million less the tax back for years 1 to 5. The cost of equity, which we're going to be using as a discount rate, is 20%. And it's part A, if you like, is a very straightforward calculation. And it's this, basically. So here we have the 100 million going out. We have essentially in here we have the 42 million coming in, and this 2.991 is the 5-year 20% cumulative factor. You are given cumulative and single year discount factors in the exam, and this is 5-year 20% cumulative factor. So here the net present value is 25.622. Of course you go for that project, there's no problem. Now what happens if we just go back a slide here, we have 70% equity and 30% debt. And the cause of the problem really is that this 30% irredeemable debt, the interest on this gets tax relief. Now we're so used to debt getting tax relief that we think nothing of it. But we have to think, why does debt get tax relief? And it reduces the price of debt, it reduces really the cost of interest by 30%. When giving people dividends doesn't reduce the cost of equity, doesn't reduce the cost of dividends. There's a very one-sided kind of a tax calculation here. That giving the suppliers of capital is not evenly handled. If you give interest to your debt suppliers, you let off 30%. If you give dividends to your equity suppliers, you're not. And being let off this 30% here, it's as though you paid the full cost of debt, and then suddenly the government gives you a rebate, chips in if you like. Makes the cost of the debt much cheaper. You're getting finance on the cheap, really. You should be paying 5% on your debt, but actually you're not. You're paying 5% less 30%. You're really paying only 3.5% on the debt. And getting this cheap debt, finance on the cheap, is worth something. As I say, it's like you paying your full whack of 5% and the government giving you 30% back, giving like 1.5% back. And giving you that 1.5% back must be worth something to the project. So this was the base project, as sometimes called, as though it was all equity. The second stage here is looking at, well, what is the value, if you like, of what's sometimes called the tax shield, being let off the tax, or be let off the tax on the interest, really, here. So the annual tax saving on the loan finance, so here we are dealing here with 30% irredeemable debt. So this here is going to be splitting into 70 million of equity and 30 million of debt. Yeah. So we should be paying 5% on 30 million, but we're getting tax relief in perpetuity of 0.45 per annum. It's like the government handing you back 0.45 million per annum in subsidies. Valued as a perpetuity at the pre-tax cost of debt. And remember the cumulative discount factor of a perpetuity is 1 over R. So the cumulative discount factor of a perpetuity is 1 over the discount rate. That's all we have here. 1 over 0.05 times the annual flow. It's worth the present value of 9 in perpetuity. So getting access, or being given this rebate, as I like to think of it, by the government here, you have your basic project, plus you're getting the value of the cheap finance. The adjusted present value is 34.622. It's much more worthwhile a project because we have financed it by the subsidized debt. C here, it's only giving us subsidized debt for 5 years. So instead of getting cheap debt forever, we're getting cheap debt for 5 years, but exactly the same principles hold. What is the value of this subsidy, this 5-year subsidy, which we're talking about here? So here we have it here, we've seen before, it's going to be 30% of the 100 million, 30 million. It's 5% is what we're paying, and we've been let off 30%. So the annual kind of saving of subsidy is 0.45. The 5-year 5%, the cumulative discount factor at 5% is 4.329. You can look that up on the discount tables, the annuity tables. So the present value of receiving 0.45, 0.45, 0.45, 0.45, 0.45 for 5 years is 4.329, your cumulative factor, times the annual saving. So this cheap debt is worth 1.9481, and so here the value of the project financed by the cheap debt is your base value plus the present value of the tax shield, tax saving, evaluated, and I repeat, you evaluate it at the pre-tax cost of the debt. Let's look at a second example. What happens if, when you undertook this project, you're obviously a bigger company, bigger assets, more assets and so on, you may have more equity and so on, and this enlarged company could borrow more. That's what's called the debt capacity. You might not borrow, but it's kind of a facility which is kind of in reserve, kind of up your sleeve that you could use some time. And simply because you haven't used this facility doesn't mean it's not worth anything. And so also this potential advantage will apply to an increase in debt capacity. So here we have an all-equity project lasts for 6 years, increases the debt capacity. We might not even have borrowed, but we could borrow if we wanted to. It's a potential benefit that we need to take into account. The risk-free rate is 5%, tax as before 30%, but this time paid 1 year in arrears. So you need just a little bit of care when we're evaluating this value of this subsidized debt here. What is the effect on the project of the finance? We're not interested in the project itself. That's really easy to work out. We're not even given details of the project in this one here. We just want to know what is the potential benefit of the type of finance that we have. So here we're saying we could borrow an extra 4 million. If we did borrow an extra 4 million, we'd be paying 5%. The tax saving per annum on that would be 30%, 0.3. And here, what we're going to be doing is saying, well, when do you actually enjoy that tax saving? It's a project which lasts for 6 years, but the tax is paid 1 year in arrears. So we're going to enjoy the tax if the project is 1 to 6, and the tax is 1 year in arrears. We're going to enjoy the tax saving 2 to 7. So what we've got in here is the 5%. 2 to 7. I beg one. The 5%, 1 to 7, because your annuity tables only of course go from 1. So this is your 1 to 7. And then you subtract from this the 5% single year 1. So you subtract that out here, and that's going to leave you in here with the 2 to 7 5% factor. If you look it up in the tables, you see 5% at years 1 to 7 is 5.786. The 1 year factor for 5% would be this one here. Subtract 1 from the other, you're going to be left with years 2 to 7, which is 6 years but deferred 1 year. And so the value of increasing the debt capacity is 0.29 million. So here, if you had a project here, you would evaluate it using pure equity finance, and then if financed in this way that increases the debt capacity, we maybe don't even borrow anything in this, but just the more equity, more bigger kind of company, more assets and so on, could increase your ability to borrow. We have to take that into account. That's what debt capacity is. And then we have a subsidy here. Cheap loan, in other words, a cheap loan which is sometimes given by governments for development purposes in areas of high unemployment. They will often give a soft or a cheap loan to people. And that's worth something as well. Not only is it the cheap loan is worth something, it's the government kind of chipping in again. You're not paying the full whack really for the finance you're getting. So here we have a project which is costing 12 million, lasts for 5 years, will be financed by debt, purely financed by debt. The company normally borrows at 8%, but the special development loan from the government will cost 6%. It's really letting it off 2% in here. Risk-free rate of interest here is 3%, and taxes payable 1 year in arrears at 30%. What is the effect on the project? We're not evaluating the project. We don't know what the income of the project is. We're evaluating simply the effect of this subsidized debt on the project. So we look at what they're actually paying. So they borrowed 12 million. They're actually paying 6%, and they get let off tax, if you like, at 30%. So if you like, the kind of tax shield here is 0.216. Starting, we haven't discounted yet, but really starting in year 2. There's going to be a tax saving on, there's going to be saving on the interest. The government is chipping in 2%. So we have 12 million, which is 2% cheaper, and that's worth 0.24 per annum. However, we have to also take into account if the government is letting us off some debt cost, we're actually losing out on some tax relief on the interest on that debt. Okay, so the government reducing our interest bill by 2% isn't quite as good as it seems. It reduces our interest bill on 2%, but we're actually losing out 30%. I think, yeah, we're actually losing out in a way 30% on that because we're not getting the debt relief. So the final and the tricky thing is less the present value the tax relief lost. So borrowing 12 million, we're getting off 2%, but the other thing is, of course, we are not saving 30% on that. It's not as big a benefit as we thought, if you like. So that's going to be coming in at this. So here we have the annual saving in a way through the subsidised loan, which is still getting tax relief. It's going to be 0.384 per annum. And what we want is to discount that at a 3% rate for years 2 to 6. And we have to start there by saying, well, this is 3% years. Well, it's not actually going to be years. We're borrowing for, yes, years 2 to 6. This is going to be the 1 to 6. And then what we do is you take off the 3% for year 1, and you're left with 3% cumulative discount factor for years 2 to 6. And so the benefit of this type of finance is that. So it is looking at the savings, if you like, from the subsidy and from the tax, and evaluating it at the pre-tax cost of debt. The final example is looking at issue costs. Sometimes you have to raise enough money to cover the issue costs. You have to spend money on your merchant bankers and your stockbrokers and so on, and then you have to have enough left to actually put into the project. So here we need to end up with 6 million, and the issue costs are 2%. So how much do we have to raise? Well, you can think that we raise an amount minus the issue costs here is equal what we need to spend. So here we're saying that we raise 100%, the issue costs are 2%, and we've left 98% to spend, and this is equivalent to what we need 6 million. So what we actually have to raise, therefore, is 6 million times 100 over 98, which is this figure here, or if you like, this one here. So we have to raise 6 million divided by 98. What we do is we pay away 2% of that at time 0. So whatever we raise, the issue costs are going to be 2% of what we raise. So we've raised this here, and immediately at time 0, usually the issue costs are paid right up front, are paid now here. And then thereafter we're going to enjoy tax relief on the amount raised, well, the interest on the amount which is going to be raised. So let's see what that might be. We haven't been given any discount rates. So let's say the cost of capital here, the pre-tax cost of capital of your debt is going to be 3%. And let's say we have in here, it's a 1 to 6. I don't have the discount tables here, so let's not worry about that. And let's say that the tax is paid not 1 year in arrear, the tax is paid each year, paid at the end of the year. What are the kind of savings that are going to be coming from this? Well, we raise 6 over 0.98. We'll say that essentially what they're paying on this is 3% per annum, the pre-tax cost of debt. So they raise that amount, they're paying 3% on that there. And what they're going to be saving, do we have tax in here? We don't have tax in here. let's say the tax rate is, let's give it 30%. So times 30%, that is the savings on paying the interest because of the tax relief and the interest on everything they've raised in here. And this is going to be for, we're paying the tax at the end of each year. This is going to be years 1 to 6. So you look up your 3% cumulative discount factor for 6 years, and that'll be the value of that. However, there are some costs associated with this. We have to pay away this amount. We pay at time naught. So, if you like, this is going to be a kind of positive figure. I don't know what it is. So there's a cost in here, which is 0.02 times 6 over 0.98. So what's that amount to? We have to pay that away now here. So we've got 6 divided by 0.98. The amount we actually raise is 6.122 times 0.02. We have about minus 0.1224 goes immediately to our professional advisors. But then this is going to be subject to tax relief. It's going to be subject, because usually these professional fees, these issue costs are subject to tax relief. Then really this is a time naught cost, but then we're going to get some tax relief on this. This is going to be felt at time 1. The tax is paid in the current year, but that means at the end of the year, so it's going to be a time 1 tax saving. We're going to be saving 0.02 times 6 over 0.98. That's the cost we actually have to pay. And the tax relief we're getting in this is 30% there. So we have our, here we have 0.1224 times 0.3. It's equal to about 0.03672. But that is going to be a time 1 saving. So what we need to do is to multiply that by the discount factor at the, where are we here? Do we have it in here? We have, what have I made an assumption in here? We have 3%, yes, I've said here. Let's pretend that the risk-free rate is 3% here, so we want the discount factor, which is going to be the 1 year 3% factor. So we get tax relief for years 1 to 6. We pay the upfront costs now, and we get the tax relief on those costs at the end of 1 year. And if you add all of those up, then you would get basically the benefit which is coming from this type of finance.